Okay, hi everyone. So welcome back again. Today we are going to do the next part of NPV, okay, which is advanced NPV. So as I told you, the basic NPV as compared to the advanced NPV is different because you are introduced to three new elements into your advanced NPV. So guys, just for you to have a direction on what am I doing today, I'm doing the FM syllabus of your NPV, the advanced NPV. Subsequent to this, I'm going to do a few questions. I'm going to identify the more difficult questions, the one that you find it difficult to do, or based on experience, students tell me that these questions are difficult. I'm going to identify out those questions, single them out, and on top of that, I am going to help you to answer the question after teaching you guys. Right now, I'm going to take it slow. I'm going to take one step at a time. I hope you guys can follow me very closely. The reason why I am doing this is because this is a very important topic where examiner said that the investment appraisal topic would normally be asked as part of the section C of your examination. So as a result of that, I would require you to pay close attention to what I am going to talk about today, and also whatever examples and whatever questions that I give you, I would expect you to follow me very closely. Just for your information, there will be some questions that I would randomly give you an example during the class, and there would be some where I actually use the examples that were sent to you as part of the lecture example. All right. Okay. Without further ado, let's start with advanced NPV. Okay. Hold on, guys. Let me share my screen. All right. So, net present value. As you already know, net present value, you need to use the concept of relevant cash flows, and also you would accept or reject a decision based on the value of your NPV. Example, if it's positive NPV or if it's negative NPV, you reject. So I think that is something that you are aware of. You already know about it and you do not have any issue. But guys, here the next part is extremely important. Why? Because this is where examiner tests students' knowledge on advanced NPV. So what I'm going to do is I'm going to give you an additional worksheet of examples where there would be some examples from the BPP book that I have used, but I've not included it in the original investment appraisal video handout. All right, so now let's start with the first one, taxation. So as you know, the three elements that are being added into your advanced NPV is taxation, inflation, and working capital. Okay, so what is taxation? Why do you need to add taxation? So guys, the logic of taxation is that you have two types of taxations. You have taxation on cash flow and you have tax benefits on non-current asset. So the first one, tax on cash flow. What is the reason that you have tax on cash flows? So as you guys, you already know, taxation on cash flow occurs because any cash flows of your company, any cash inflow of your company would be would attract a tax payment. So example, if you have a profit in year one, so that's a net cash inflow. So as a result of that, that amount would attract tax at the tax rate that is given by your examiner. So just to give you a direction, right? Number one, net cash flow usually occurs when taxation on net cash flow occurs when the operating cash flow is positive, when the operating cash flow is positive, On top of that, when you have a positive operating cash flow, the logic is whatever income of your company attracts a tax payment. That means if you make a profit, you need to pay tax. So you will take the operating cash flow, right? You will take the operating cash flow. You will multiply by the tax percentage or tax rate. Okay, guys, just to remind you, operating cash flow is your sales minus variable cost minus fixed cost. All right. And when you multiply by the tax rate, I just want you to remember that this tax rate is actually given by the examiner. In the question, you definitely will find the tax rate in the other information or somewhere throughout the scenario. Now, guys, I just want to remind you, all right, that the tax rate for every question, it will vary. So as a result of that, I want you to be extra careful because I don't want you to work on default. What do I mean by work on default? So normally what happens is that whenever you are a student and you have practiced too many questions, you will notice a trend. Example, let's say most of the NPV questions, the tax rate is 30%, right? So because the questions for the most part is 30%, what happens is when you are rushing, when you don't pay attention to the details in the question, there is a possibility that you will accidentally take 30% when in reality, the question may actually only give you 28% or 21%. So you just need to be careful of that because I don't want your brain to work on default. Look at the question, find the tax rate. If the tax rate is 30%, you write it in your exam sheet. If your tax rate is 28%, you write it there. You know why, guys? Because if you don't do that, the tendency of you to take the wrong figure is very, very high. And when you take the wrong figure, you know what happens? You're going to lose 1 mark there for no reason. Now, even though I say it's 1 mark, the 1 mark is the difference between your 49 and your 50. Plus, this is an easy mark, 1 easy mark. I do not want you to let go of easy marks just like that. Okay? Now, I just want to remind you of another thing, okay? That whenever you look at the question, you need to ensure that you identify whether the question requires you to calculate the cash flow with tax or without tax. Because some questions, he might say ignore taxation. If he says ignore taxation, I want you to make sure you do not put any taxes. Then you're going to ask me, Miss, why do you tell me this thing? Because guys, you will not believe it. There were some students that I've taught before. Whenever there were no taxation, they panic and they thought they read the question wrongly. And they go and assume tax rate is 30% and they calculated tax. That is not correct. That is incorrect. That is not the way you're supposed to do it. Okay, so please be careful of that. So I'm just going to repeat. Whenever your operating cash flow is positive, that positive cash flow will attract a tax. So you need to take your operating cash flow, multiply by the tax rate or tax percentage that is given in the question, and you will get your tax payment. So your operating cash flow positive, your tax should be negative. Guys, also quick reminder, the tax percentage will always be given in the question. Now, let me ask you a question. What if the tax rate is, what if the operating cash flow is negative? Would you have to pay tax on that amount? Think about the logic of it. If it is positive, your tax you need to pay. If your cash flow is negative, normally you do not have to pay tax. You will get a tax refund. Example, if your profit, okay, so your operating profit, operating cash flow is negative 500. When you take multiply by 30%, your tax here is a positive cash flow 150. Why? Because when your company has losses, you will have a tax benefit where you have the tax saving on your company losses. Okay, so these are the only things relating to the cash flows. There shouldn't be anything else, all right? Okay, in terms of the cash flow. But when you talk about capital allowances, all right, when you talk about capital allowances, what is capital allowances and why do you have capital allowances? So guys, remember just now I said tax benefit on a non-current asset. So what this is, okay, it is a tax benefit that you get because your company purchases a non-current asset. So guys, can I ask you a question? Why is it that your company will get a tax benefit on non-current asset? What is the logic? What is the reasoning that you will get this tax benefit? Does anyone know? Think about it, okay? So normally, a company will get a tax benefit on non-current asset because what happens is that the government will want to encourage your company to purchase more assets to increase the productivity and the profitability of your company. So to encourage you to buy more assets, they will give you a tax benefit or a tax relief on non-current asset. Now, why is it that they want to encourage you? Because the higher the productivity and profitability of your company, the higher the tax revenue that you will pay the government. So it's a win-win situation. If you buy assets, you generate more income, you need to pay more revenue. So as a result of that, the government will give you a tax relief for purchasing non-current asset. Now guys, I'm going to ask you another question. So when I say tax benefit, what will this tax benefit be based on? Is it based on the asset value, or is it based on the cost of the machine, or is it based on the scrap value? What is this tax benefit based on? So this tax benefit, okay, remember I told you it's called capital allowances. Because it is called capital allowances, actually the concept of capital allowance is that capital allowance is the tax term, okay, tax terminology that is used for depreciation. So what you do is you just calculate depreciation of your machine. That depreciation value you multiply by the tax rate, you will get your tax saving or your tax benefit amount. So because I mentioned the word depreciation, you now need to understand that there are two methods for you to calculate depreciation. What are these two methods? Number one, you have the straight line method. And number two, you have the reducing balance basis. So two bases to calculate your depreciation. So do you remember your formula to calculate your straight line and reducing balance basis. Anyone here remembers? Because sometimes when I teach my FM students, because they have left it for a while, they tend to tell me, yeah, miss, I forgot. Okay, so just be careful of that. Okay, now the formula for your straight line depreciation is depreciation equals to cost minus scrap value over useful life. So when you do this, you will get your depreciation per year. In order for you to get the tax saving, you multiply this by the tax rate. So depreciation multiplied by tax rate, that is the amount of tax saving. Now, I just want to remind you that means the tax saving on a yearly basis is constant. Why do I say that? Because your depreciation, when you use a straight line basis, your year 1, 2, 3, 4, 5, and so on, it has the same value. That's your same depreciation value. So your tax rate is also constant, let's say at 30%. Hence, your tax saving on depreciation will be the exact same value. Okay, I put it up here because I didn't want to cover this, yeah, in case. So just be very careful of that. Okay, when you calculate tax saving on straight line depreciation, maybe you want to write that down somewhere. Okay, let me erase all this. Oh, sorry guys, let me erase all this and then I will write it for you. Okay, when using straight line basis, the tax saving on capital allowance is constant every year. Okay, so just be a bit careful of that. Okay, the reason why is because when you calculate straight line depreciation, your yearly depreciation is a constant value. All right, so that is the straight line depreciation methodology. Now the next one is your reducing balance basis. Okay, I just want to remind you that the concept of your reducing balance is exactly the same as calculating depreciation. So when you are calculating depreciation using the straight line basis, do you remember how you do it? You take your cost, you minus your depreciation, you get net book value, and then on that amount you will minus depreciation again. So sorry, I need to switch my screen. Okay, so here, okay, so what I want you to do is, okay, so tax saving, capital allowances, okay, but now I'm going to do the reducing balance basis. Okay, so number one, how do I do it? Okay, the first thing I need to do is I need to calculate my depreciation in the normal method that I use, which is the reducing balance basis. So year, cash flow, tax percentage, so whatever percentage is it, and timing. Guys, please follow my methodology if you don't have your own methodology right now. Okay, the reason why I say that is because this will really help you in an event where you get confused or you are lost. Okay, I always have a structure on how I do everything. So I'm hoping that this structure will actually be of good help to you. So when you do your reducing balance basis, what you will do in year zero, cost. Year one, you will start to depreciate. So he will give you the reducing balance percentage. Normally he will give you, I mean, not normally, he must give you. So this is your depreciation. You get net book value. Then you less your depreciation again on the reducing balance percentage. Again, you get net book value. And then it goes on. In the final year, okay, you will minus scrap value because you're selling the machine, and you will be left with an amount which is actually balancing allowance or balancing charge. Okay, guys, I need to explain this to you. Whenever you want to calculate tax saving for the first year until the year before you sell it, the tax saving will be on the depreciation amount. So 30% on the depreciation amount. In the final year, the year where you sell, the tax saving will not be on the negative amount, not on the scrap value. It would be on the balancing allowance or balancing charge. Now, this column here is a tax saving. So even though your depreciation is negative, this amount multiplied 30% is a positive value. Now, when it comes to balancing allowance or balancing charge, it's quite weird that it appeared as an arrow. Balancing allowance or balancing charge, okay? What is balancing allowance? What is balancing charge? Balancing allowance is the amount of tax underclaimed. Balancing charge is the amount of tax overclaimed. Okay, I want to remind you, when you are calculating balancing allowance, right, it should be a positive value because this is the amount left for you to claim. When you calculate balancing charge, it should be a negative value. So amount of tax underclaimed, the positive value, okay, amount of tax underclaimed, the positive value means you can still claim a tax saving, so it will be positive here. If your balancing charge, that means if your value is negative, it is a balancing charge. And because you have claimed too much tax, you need to pay back a certain amount. So it will be negative in this row and this column. Okay. So if this is clear, what you will do is whatever item you have in the tax saving column is what you will transfer into your NPV format. Okay. I'm going to draw down your NPV format for you. So you can see how it looks like for the advanced NPV format. Okay, so guys, I hope you can see here. This is my format: year, sales, variable cost, fixed cost, operating cash flow. Now, this is your new item. Initial investment, scrap value. These two are your new items. Then you go on NCF, discount factor, PV, and NPV. Now, this amount here, it will be a positive value in this column. Sorry, in this row. Okay. So if your tax pay in year one, you will show this in year one, so on and so forth. Okay. Now I need to explain another more important thing for you, which is the timing of cash flow. So guys, for the purpose of your FM paper, you need to be careful about the timing of cash flow. So what does it mean by timing of cash flow? Sorry, my background is a bit noisy. I don't know what happened. Okay. So what does it mean by timing of cash flow? Okay. Timing of cash flow means that the timing of your taxation, because your examiner, what he normally does is he will do one out of two things. Either he will say tax is paid in the current year or the year cash flow arises. Means tax is paid in the current year or the year cash flow arises. All right. So when this happens, that means if you have cash flow in year one, that means you have a positive operating cash flow in year one. So you will have a tax payment in year one. So remember, when your profit arises in year one, your tax will be paid in year one. Now, the next one, if tax is paid in arrears, so he will use this term, tax paid in arrears or 1 year after profit arises. Right? So tax is paid in arrears or 1 year after profit arises. What you do is, okay, your year one will have no tax, but for year one, the tax will be paid in year two. That means tax is paid in arrears, 1 year in arrears. That means in year one, right, your cash flow for the taxation row will be 0. But for year two, you will have a tax payment, but this value is year one cash flow multiplied by tax rate. You will put it in year two. So as a result of that, what you need to do or what you need to know is, if tax paid in arrears, your NPV have to plus 1 column. So if he said that the useful life is 4 years, you plus 1 to make it 5 years. Are you all good? Are you all okay? Right? Because The cash flow for year 4, you need to show it in year 5. And you don't have any other cash flow in that column. You only will have the tax related item. Are you guys good? Okay, so these are the two most important things that you need to know about taxation. So guys, what I will do is I will do a very short question with you guys. Okay, I'm going to copy and paste my question in another sheet so that it was easier for me to do, so that I can just have one question in that particular sheet. But don't worry, you guys, you will be able to get that question because I will send that in as part of your question compilation. All right, so just give me one moment. Let me copy it from the original file. So yeah. Okay, so I'm going to use this one question just to do the taxation calculation part. I'm not going to take the whole question. We probably will do this whole question after I complete tax, working capital, and also tax, working capital, and also inflation. Then I will do this question together. Okay, but I'm not going to do the question now. All right, I want to just focus on the taxation calculation. So guys, look here. For this question, I'm going to direct your attention to only the taxation part. So Tongo is paying tax at 30% and is expected to do so for the foreseeable future. Tax is payable 1 year after profit summary. So this means tax in arrears. Allowable depreciation is available on fittings and equipment only. So it's only available on the fitting and equipment. So if there are so many other non-current assets, please remember to remove those non-current assets out so that you only use the correct cost value. The tax allowable depreciation is available on a 25% reducing balance basis. Resale proceeds are 200,000 and the total figure of 4.5 million given above is actually including the 200,000. So if you go up here, you can see furniture and equipment, the cost is 750 and the resale value is 200. So now if I want to do the reducing balance basis, here cash flow, tax at 30% and timing. Year 0, my cash flow is 750,000. Year 1, I will start to depreciate at 25%. Okay, so 750,000 multiply 25% is 187,500. Net book value is 562,500. Year 2, guys, I will continue to depreciate it. 140,625. So the value that you get would be 421,875. Year 3, again, you will depreciate it. 105,469. Your net book value is 316,406. Now guys, remember This is something that I want you to pay close attention. After this, since my project will end in the 4th year, what I will do is I will minus scrap value 200,000. The value that I will get is 116406. This is a positive figure, hence it's a balancing allowance in year 4. Now, when I want to calculate it, tax at 30%, 187,500 multiplied 0.3, this is 56,250. 140625 multiplied 0.3, 42,188. 105,469 multiplied 0.3, 31,641. Guys, remember, in the final year, it's not on the negative amount, it's on your balancing allowance, which is 116406 multiplied 0.3, 34,922. Okay, I hope this is very clear. And then these items will be included at year 2. Remember, year 1 you don't pay any taxation. You pay 1 year later, so it will be included in year 2, year 3, year 4, and year 5. So this is what will sit in your NPV format. All right, don't worry. I'm going to do questions later after I've completed all 3 items. So if you find that you don't really understand, please go back to my video and watch the explanation for each part so that you understand. Okay, I just want to explain one more thing. If you notice, the examiner has said or used the term TAD, tax allowable depreciation. What is your tax allowable depreciation? This item, your depreciation that you have calculated here, all these are your tax allowable depreciation item. Why do I say tax allowable depreciation? Because these items are actually the depreciation amount that attracts a tax benefit. Okay, the depreciation amount that is allowable for your tax benefit. That's why it's called tax allowable depreciation. Actually, it's just depreciation. But the reason you call it tax allowable depreciation is because you get a tax benefit on the depreciation amount. So that depreciation, you have a allowance for tax. Okay, that's why it's called tax allowable depreciation. All right, guys, I just want to remind you, when you add the additional column, year 5, common mistake of students, they tend to put the scrap value in year 5 instead of year 4. Just make sure that you put your scrap value in the correct column. Remember, I told you that this amount, all right, this year 5 column should only consist of tax item and nothing else. If you have any other cash flow there, that means your calculation is wrong. All right. So with this, I end this video by talking about taxation impact on NPV. The next video, I will talk about inflation and working capital. And then I will do a few tutorial questions for you guys so that you can follow me very closely so that you will be able to answer every single NPV type question. Okay, so if you want to do or you want to learn about inflation and working capital, it will be in the next video. So guys, I will see you in the next video. I will maintain this lecture example. I will use this lecture example as a basis for me to explain inflation and also for me to explain working capital. And subsequently, what I would do is I will move ahead to doing past year examination type question, so that you have proper knowledge and appreciation of the NPV format and also formula. All right, so see you guys in the next video.